Well, our first smart topic is one that affects us all, the Valley's housing market. Newly released numbers show the recovery is going to be a lot slower than we are used to, and we'll likely won't see a rebound until 2014 or 2015.
Yeah, a lot longer than we thought. Foreclosures are still flooding the selling market. And right now, experts say about 40% of the homes for sale in the Valley are foreclosures. And that's compared to 1% we would normally see in good times.
That's right. And new home prices have dropped again this year from a median of $227,000 to $222,000 in Maricopa County.
Experts say that the unstable job market is also keeping people from buying a home. But that recovery is happening slowly, more so really in the East Valley, where home values and new home permits are starting to pick up.
Yep. Well, there is new protection for any of you who are struggling to make your mortgage payments. ABC's Rudabeh Shabazi explains how this one tiny adjustment could have a huge impact across our state.
From the future we planned, prayers of recovery slip away like fine grains of sand.
Donna Tognoni's poetry was her outlet after she and her husband Alan had to short sell their home.
It felt like someone just tore your heart out, and we lost everything overnight.
Like thousands of others of underwater homeowners, the bank told them they couldn't modify their loan unless they were delinquent on their payments.
When they bought the loan, they were told, keep the loan for a year or two, refinance your house, and you'll be fine. Well, the market collapsed. When they tried to get it refinanced, everything went to Hades in a handbasket. There was no way they could dig themselves out.
Alan Tognoni's dream was to retire in Arizona with his family. But after 30 years as an iron worker, he had to go back to work to try to recoup the investment he lost.
We've worked all our lives to save all our money to come out here to do this.
But now there's new legislation in effect designed to combat predatory lending practices. When the bank suggests you stop making payments, they must follow it with this disclosure.
If you stop making your payments, you could lose your home and damage your credit. If those statements are not made to you, the people who are making those statements are breaking the law.
But the Tognonis took their realtor's advice, not the bank's, and kept making their payments. If they hadn't, they wouldn't have this new house to call home.
Our journey continues as we cling to our ropes, a vision of future change and a reason for hope.
Wow. Well, what is being done to stop these bad lenders or banks from giving us consumers some bad mortgages? Well, joining us now is consumer finance expert Dean Wagner to talk about how we can protect ourselves, and there is a new law out. So welcome, Dean.
Hi, how are you doing?
I'm doing good, I'm doing good.
Good, yes.
Well, let's talk about this. It's a new act. It's called the Dodd-Frank Act. I know, spelled D-O-D-D, Frank Act. And so let me read this to you. This is actually a quote from the act. It says, an act to promote the financial stability of the United States by improving accountability and transparency in the financial system to end, quote, too big to fail, to protect the American taxpayer by ending bailouts to protect consumers from abusive financial services practices and for other purposes. So, Dean, can you explain that to me? That is quoted directly from the Dodd-Frank Act. So kind of put that in more layman terms, what that act means and what's the purpose, what's the good and what's the bad.
Well, this is the largest financial act in the history of the United States. In fact, that act's 2,300 pages long, so there's a lot. And it covers a spectrum of different financials. Pertaining to mortgages, it's to keep well, there's a lot of changes as far as the type of loans, but also on the origination from loans. And one aspect is on the originator side is what we do is we help people get into houses. On April 1st, which is just about, 5-6 weeks away, they changed an act where you can no longer have different commissions, and so everybody's charged the same exact amount.
Okay, wait, I'm confused. You said April
1st of 2011.
Okay, April 1st, this is when this act went into effect.
Well, this is one aspect of this act. Now, there's a lot of aspects, but one that directly affects a lot of people employed in the industry and people buying houses is the fixed commission, which a lot of people are not aware of, and there's good parts to it and there's bad parts to it.
Okay, so that's when, like mortgage brokers or whatever were getting, and this by no means are we saying, all people, but they would get kickbacks when actually the consumer should have gotten that check instead of, a mortgage broker or lending institution.
Exactly.
So now that has changed there.
And people are familiar with the concept that mortgage people made very large commissions when you bought a house. And what this act does is it attacks that, and it says that you cannot rip people off essentially anymore, and you're going to make the same amount whether you're buying a $50,000 house, a $400,000 house. If you have perfect credit or if you have horrible credit, everyone's charged the same amount, and this applies to that bank only. So it's different at every bank, but if you're applying at that one bank, you can be sure if they give you 30 different options, they're making the same amount on all 30.
Okay, so it's not like you walk into a bank, I walk into a bank, you have a nicer suit, I don't, so they give you a better deal than me. That doesn't happen anymore.
It's gone.
The fees are the same depending on the institution.
Exactly.
Okay, got that. Okay, got that. Okay, so that's a good thing. So give me one more good thing.
Well, the other good thing is, if you're brand new, if you're a first-time home buyer, and let's say your parents are back east, usually people come in, they apply, you're a first-time home buyer, mom and dad are sitting there, and aunt and uncle, and they're looking at it, and bottom line, and how much are you making? There's a lot of that negotiation, almost like that car stuff, all that's gone. If you're a first-time home buyer, just go to, apply at like 2 or 3 different lenders if you're comfortable, or if you're going with somebody that came highly referred, but just go in and just know, if they're telling you 3 different options, don't think that there's a motive behind it. They're going to make the highest commission on this one as opposed to these.
Okay, because they're all getting paid the same.
It's the same.
Well, the other good thing, too, is that banks now also have to tell you your fees and the rates of different things when it comes to your loans. Like, what's it going to cost? So you know that up front.
Full disclosure up front, so you know
like
exactly what your payment is, exactly what your down payment is, and closing costs.
Okay, now, in your opinion, you say that there is a downside. Now, this is your opinion where you're saying this when it comes to this particular act, and you think that the effects may be.
Correct. Well, the majority of Americans have really good credit, and they shop, and they've always gotten really good deals. So a lot of the high commissioned, where you were making, say, 3%, 4%, 5%, those were those nasty subprime loans, and those are gone. Those are wiped off the planet. We haven't seen those in several years. So we're not sure if this is too much regulation, too late.
Okay.
And so that's a concern. The second thing is, because it is a fixed price, people buying $50,000, $60,000, $70,000 houses, there really isn't any commission in those deals anymore. So the fear is those people are not going to be able to get financing. Those houses are on the market longer. The longer they're on the market, they drop their prices, and then you're starting to see those lower prices, those houses drop. So we don't need prices to keep going down.
Okay, I got that. Okay, now, we do have some specific examples of some things that people should look at when you have a loan. So we have one example where we've got an FHA loan.
FHA loan, $150,000.
So typical breakdown. I think that's we're going to get that graphic to pop up. There we go. So we have a sale price of a $150,000 home. With an FHA loan, you can put 3.5% down, so it would be a little bit over $5,000. Okay, so your payment would be, that's principal and interest. That's $740.76, and then MIP, $138.72. Can you explain that to me really quick?
Mortgage insurance premium. This is the profit that FHA makes for insuring this loan, and if your loan goes into foreclosure, the FHA insurance will take care of that lender, and then that will turn into a HUD home. So if you ever wondered why the government has HUD homes and foreclosed homes, that's because the FHA insurance protects that lender, and the government will take that house, repossess it, and then they'll deal with selling that property.
Okay, so that's the insurance, so it's kind of a guarantee, which is something that is more consistent. But like Home Path Financing does not have that M&I, the mortgage, MIP.
MIP, that's right. Now there's Home Path Financing. This is unique to just Fannie Mae foreclosed houses only.
They have to be Fannie Mae.
Right. The beauty is it's only 3% down. There's no monthly mortgage insurance. It does carry a lower payment. The interest rate's a little bit higher than FHA, but if you can get that financing, it's a really good way to go.
Okay, and 20% down could you be ideal, but Dean, I'm running out of time, so thank you.
We could talk all day.
I know, we absolutely can. So, you know what, we're going to take a couple of Facebook comments because we were asking you, well, we're not going to do Facebook. Connie, it's all yours.
All right, thank